The one caveat to buying a business with 100% financing options where you're paying all these loans back is to make sure that the business...
Welcome to Business Buying for Financial Independence. I'm Tim Delaney, and I help young professionals buy small businesses so they can escape the 9-to-5 and take control of their time, income, and future. If that sounds like you, hit the subscribe button and let's get into it.
You've probably heard the phrase, buy a business with no money down. And your first thought is probably, yeah, right, that's a scam. I mean, heck, even I talk about that a lot. But it's not a scam. It is possible. And in this video, I'm going to break down exactly what I mean when I say that and what it actually looks like in real life and what you should watch for if you do this route. What it does mean is that, in theory, you can own a business with zero of your own dollars out of your pocket. There are ways and methods of financing a business purchase that do not require you to go into your pocket and take money out to buy the business. You might still need money for working capital. You might still need money for closing costs. You might still need money for some type of down payment or to be held in escrow or for some other reason. But that money doesn't always need to come out of your personal money. There are ways to finance an entire purchase. Doesn't mean that the seller is just handing you the keys to the business and walking away and you have it free and clear. There is going to be a financial obligation tied to that business purchase. It's not free. So $0 down just means that you're not using your own money out of your bank account. I did a podcast episode recently with Lindsay Zajac, episode 5 of Business Buying for Financial Independence, where she explained that she bought her business with just the revenue from the existing business. She didn't have to go into her 401k. She didn't have to pull money out of her savings account. So it is possible. There are examples out there of people that do it. So how does that happen? In Lindsay's case, she was approached by the business, by the company's owners, because she had a very similar business that she was launching on her own. They brought her in as an employee with a plan to transition her to the owner through a seller finance sale. What seller finance means is that the seller becomes the bank. So instead of going to a bank to borrow money to buy the business, the seller is selling you their business and lending you the money to buy the business from them. I know it sounds confusing, but one of the examples that I've given in the past is, let's say that you have an old car that you want to sell to your 16-year-old child. They just got their license. They're ready to start driving. They don't have enough money in the bank to go out and buy a car, but you want them to have a car because it makes your life easier. So let's just say that car is worth $5,000 that you have that you want to give to them, but you want to make them pay for it. You know they don't have $5,000 in the bank. So what you do is you say, all right, instead of giving me the $5,000 check today, you can have the car. It's yours. Title's in your name, but you owe us $500 a month for the next 10 months or $100 a month for the next 50 months. Or somewhere in between. That is called seller financing. You are financing their purchase of that vehicle. Now, you could complicate it a little bit more by adding an interest rate on that. So instead of just flat, evenly divide those payments over whatever time period it is, you would typically add an interest portion on there as well. And that's what a seller would do when they're selling a business. Don't expect it to just be even equal payments. You are going to pay a little bit extra for the ability to finance it, like you do when you buy a house, like you do when you buy a car from a dealership, or anything else that you finance. There's going to be an interest component to it. So that seller financing can be anywhere from 1% up to 100% of the purchase price of the business, or even beyond that, actually, if they decide they want to lend you some extra money to use as working capital or a line of credit. So anywhere in between 1% and 100+% is what seller financing can be. So in that case of them saying, yeah, you know what? The business is worth $500,000. We will give you the business today. You just make payments of X number of dollars for the next 5 years every month. And then the business is completely yours. You don't owe us any more money. Or they could maybe say, we'll give you a loan for $250,000 where you make those payments over the next 5 years, but you got to come up with the other $250,000. Now, how can you get that other money? A, you might have in your pocket. Then you're not really buying it with $0 down, but that is an option for you. The other option is SBA financing or bank financing. So you can go to the bank and ask them for a loan to buy the business. Now, if the business has good financials and a solid track record, and you have some knowledge and good credit, the bank will say, sure, we'll give you the money. We can see that the business makes enough money to cover the loan, and it's been in business for a while, has a good track record. Here's the loan. They write that $250,000 check to the sellers, and then now you're making a monthly payment to the bank and a monthly payment to the sellers until you've paid off both of the loans. So you have a combination of loans there, a seller financing and the SBA financing or bank financing. SBA, the Small Business Administration, is willing to help banks make business loans by guaranteeing a portion of those loans in the case that the business stops paying. So a lot of banks in the US will work with the SBA program wherein they will lend the business money, but it's approved by the SBA so that the SBA will back it up. If that business goes out of business, the bank gets some of their money back, which gives them a little bit of peace of mind in making those loans. Now, I know of banks that will not work with the SBA because it's a little bit more complicated. There's extra paperwork. It makes the closing process longer for the buyers and sellers. So they just do it themselves. You know, they might have stricter criteria. They might have their own criteria that they look at, or there's banks that will only do SBA loans. So they will only lend the money to a business purchase if the SBA is going to back it. But in either case, these bank loans, SBA loans are a way for you to get the money to buy a business with no money out of your pocket if there's a piece of seller financing in there. Now, if the seller's not willing to finance anything, the SBA or the banks will typically like to see the buyer put some percentage of the cash into the deal. This is where it becomes it's no longer a no money down purchase of the business. You're going to have to come up with your own cash. But there is a little loophole there because you could tap into other lending sources, such as your home equity line of credit or a home equity loan, which you pull out personally and then use that to buy the business. So again, you're not necessarily rating your savings account or your 401k or anything else that is cash and earn or investment stocks that you own. It's borrowed money from another entity to combine with that bank loan, that SBA loan purchase of the business. If loans financing, seller financing is not going to work out for that $0 down, another option is partners. You can look at partners in two different ways: equity partners and financing partners. Financing partners are going to be people that lend you money. So if the seller is not going to lend you, doesn't want to do seller financing, but the bank is willing to do a financing, but only 80% of the purchase price, you need to come up with that other 20%. If you don't have home equity to borrow against, or you don't have other assets to borrow against, and you don't want to tap into savings accounts or stock accounts or whatever else it may be, you could borrow money from a third-party person. You know, this could be a family member that has a large retirement account that they're willing to lend against, or it could be just another business person in the community that's willing to give you a loan because they know the business and believe in it and believe in you. You could also bring in an equity partner. This is somebody that would take a percentage of the ownership of the business. And this can be structured in a lot of different ways. It can be equal parts of how much money you each put in, But if you're going for the $0 down, you don't really want to go that route because you would own 0%. Typically, your sweat equity or your willingness to run the business would be your portion of the equity. It can also be you signing for the bank loan and them not signing for the bank loan that gives you a higher percentage of the equity. On Business Buying for Financial Independence podcast, I recently spoke to Aurelius Chavez, who talked about the fact that he bought a business with two partners. Him and one of the other partners, all three partners brought the same amount of cash to the deal, but two of those partners signed personally for the bank debt, meaning that they're personally on the hook. If the business goes bust tomorrow, the two of them have to pay back the bank no matter what. Whereas the third partner did not sign for the bank loan and therefore took a much smaller percentage of equity in the business, because it's almost like Aurelius and that second partner were bringing more cash to the deal because they're the ones that borrowed it from the bank. Even though the business is the one that's borrowing it, they still got a higher percentage of equity because they signed for it personally. So when you bring in an equity partner, there are different ways to structure that deal. Remember that your sweat equity is worth something. Remember that your willingness to sign for other loans is worth something. And so it's not just an even split. So you could bring $0 of your own money to the table, wherein somebody else is bringing 20% of the purchase price, and you could split that business equally, 50-50. You could split it where you're getting 75 and they're getting 25. You can split it where they're getting 75 and you're getting 25. It's really whatever works for you, but it is a way or an option for you to get into a business with $0 out of your own pocket. Another method that's a little bit less common in a very small business purchase would be earnouts or kind of performance-based payments. This would be essentially what this means is that the sellers are getting certain payments or certain earnings based on how well the business performs going forward. A lot of sellers don't like this because they don't know you. They don't know how well you're going to run the business. They have to put a lot of trust in you to get paid in that method. So it's a little bit less common, especially in the smaller business realm of purchases. But in theory, it is a way to get a business with no money out of your pocket. What you can do is combine that with seller financing or combine that with a partnership or some other structure where you are paying the seller a certain amount of money based on how well the business does, either above and beyond what it had been doing or consistent with what it had been doing, so that you don't have to bring any or as much cash to the table up front. Another avenue for buying a business with no money down that is, we kind of touched on a little bit, but just generally credit lines or other business credit. So if you already own other businesses or you already own a lot of real estate, using that to leverage against the business or to use that to leverage against in order to get cash to buy the business. Again, that's not actual dollars out of your pocket, which is why I would still say that that's no money down in this scenario, because you're borrowing other people's money to buy that business. So those are kind of the major ways that a deal can be structured without physical dollars coming out of your pocket or out of your bank accounts. Any combination of those is also possible. And again, I'm not saying that you're going to walk out tomorrow with no money in your pocket, no money in your bank, and go find a business to buy. It's going to be easier if you do have some assets, some cash available. Not that you necessarily have to use it to buy the deal, but there will be brokers that want to see that you're serious. And the way that they vet that you're serious is by seeing that cash in your bank account or cash available. So it will be helpful if you've saved some money. It will be helpful after you've bought the business if you have some cash available in case of emergencies, either personal life or business-wise, that you're able to put some into it. So I'm not saying if you're dead broke, go out there and try to find a business with no money down. It's generally not going to work very well. But again, it is possible if you have the other right assets in place, the knowledge, the experience, the connections, that you could buy a business with no money down. My personal example, when I bought my wine and liquor store, I'd put some cash in. I liquidated stock, some stocks that I had, and I emptied all my bank accounts in order to put all my cash into the business. The majority of my money came from a bank loan backed by the SBA. And then the sellers also financed a good percentage of the purchase as well, about 10%. That's how I did it. I had 5 to 10% cash, my cash into the deal, which is still really, really low when you consider the fact that I bought an asset worth $350,000 for about $35,000 out of my pocket. That also cash flowed and gave me a paycheck the first week that I worked there. Even when you hear no money down, buy a business with no money down, and you think, that's a scam or that's not going to work. Just remember that even if you have to put in a little bit of that cash, 5, 10, 15%, it still might be an amazing deal for you. The one caveat to buying a business with 100% financing options where you're paying all these loans back is to make sure that the business can actually pay for all those loans. You don't want to buy a business with 100% financing and not be able to pay that monthly debt payment with the profits from the business. Banks generally won't let you do that. So if you have a bank involved, they're going to be looking at those numbers and they're going to tell you if that's the case and probably not give you the money. But the sellers might not care. They might not look at it, especially if you're signing personally and you have other assets that you could lose. If you stop paying them, they'll take back the business and or go after you for your other assets that you own to make them whole if you've ruined the business in the process. So making sure the debt can be covered by the profits of the business. There's some nuance to debt and the way it's calculated in a profit and loss statement that seems to confuse a lot of new business owners as well. When you take a loan, when you're paying back a loan, you have an interest portion and you have a principal portion. That interest portion generally shows up as an expense on the profit and loss statement. So after you're done with your profit and loss statement, you have your profit, hopefully it's a positive profit at the end of the year. That does include the interest portion of that loan payment, but it does not include the principal portion of that loan payment. So your profit has to be large enough that you're also covering the principal portion of those loan payments. Otherwise, you will run out of cash. And it won't be readily apparent on the profit and loss statement. That's where you also need to look at your cash flow statement. We can get into that in more depth in a future conversation. But for now, I just want to leave you with that caveat and that warning of if you're going to use 100% financing or any financing for that matter, just make sure that the profits from the business will cover those debt payments in full, interest and principal. So these were the ways that you could buy a business with no money down, seller financing, bank/SBA financing, partners, whether financial or equity partners, earnouts or performance-based payments, or just general lines of credit or business credit from other sources. Hope you found this helpful. I hope that explains it a little bit. I know I've been getting some questions from people about what exactly it means or how you buy a business with no money down. If this did not answer you fully, please hit me up in the comments and let me know how I can explain it more or what other specific questions you have about this. And I'd be happy to address that, whether in another video or podcast or through a conversation in chat or email. So thank you for watching today. Really appreciate your time. Please take a minute and hit that subscribe button. Would really appreciate some more subscribers. And I will talk to you again soon. Cheers.
Thanks for listening to Business Buying for Financial Independence. If you're serious about owning your time and building long-term wealth, make sure to subscribe so you don't miss the next episode.